Don't withhold for taxes when you do a Roth conversion. Yes, it's taxable. Don't withhold for taxes. What should you do instead? Got that and more coming up. I don't like withholding for taxes when you do a Roth conversion. The name of the game when you're doing a Roth conversion is to try and get as much of your wealth growing in that Roth as possible, growing tax-free for your financial future. And when you withhold taxes, that means you're paying tax on some dollars from your pre-tax 401k, pre-tax IRA, traditional IRA, that don't land in your Roth because you've got to send a chunk, or you're sending a chunk to the IRS. So you don't have as much money that as you possibly could into that Roth side. Therefore, I don't want you to withhold for taxes when you're doing a Roth conversion. Now, to be fair, if you don't have any other options, then maybe withholding for taxes is the right thing to do. You've got to work with your certified financial planner, because if you're age 50, if you're younger than age 59 and a half, withholding for taxes on a Roth conversion brings about a penalty as well. And so certainly that's one of the reasons why I don't like withholding for taxes. But I also just think withholding for taxes on a Roth conversion, it works against you. It goes opposite from that objective of trying to get as much of your wealth growing tax-free as possible. So if it's a taxable event, doing a Roth conversion, it is. And I don't want you to withhold for taxes so that you can get the maximum amount possible landing into that Roth growing tax-free for your financial future. What do you do instead? Well, my favorite thing to do is to soak up an existing refund. Soak up an existing refund. How do you do that? Let me give you an example. Recently meeting with some newly retired folks. They've been retired for a couple of years, and they're living off of, she's got a small pension, they've got Social Security, and then they're withdrawing a little bit from their IRA every single month. And then we get to the end of the year, and sometimes they ask for a little bit more out of their IRA. We get to the end of the year, right about now, the fourth quarter, and we do a tax projection, and we take a look and say, well, here's what it looks like your tax return is going to turn out to be. And for them, and this has typically been the case for the couple of years they've been retired, they've got a little bit of room between where their taxable income is and the top of the 12% tax bracket, the top of the 12% bracket. So we looked and said, well, you've got about $15,000 of extra dollars between where you are right now in the top of the 12% tax bracket. Let's do a $15,000 Roth conversion. Yeah, and we talked about it, taught it, and they said, yep, that makes a ton of sense. Let's do that. That's going to create a lot of benefits for them because it will avoid RMDs out there in the future and build wealth and a tax-free side for future withdrawals and also for inheritance for kids. Lots of reasons to do this. But here's the other good thing. And that Roth conversion, we realized, well, you're getting about a $2,000 refund already. Right now, if we don't do anything, it looks like your withholdings, because he's withholding on his Social Security and then we're withholding, of course, on the IRA withdrawals. There's some withholdings on the pensions, but it all added up to, you're going to get about a $2,000 refund. Therefore, we did that Roth conversion of $15,000. They're going to be in the 12% tax bracket. Do the math on that. We didn't withhold anything. We didn't, because doing so would have just made the refund that much bigger, or would have just kept a big refund. Instead, we didn't withhold anything. And instead of getting a $2,000 refund, they're going to get much closer to a couple $100 or close to break even instead of getting a refund. So if you know, well, I've already withheld enough, or I've already got a refund there, doing a Roth conversion and then just basically using up that refund instead of getting a refund, owing a little bit, breaking even, something like that. That's my favorite way to cover the taxes on a Roth conversion. Now, what if you don't have a refund that you're already working with? Well, the second way you can do it is increase your withholding from other income. Increase your withholding from other income. And you might say, Mike, that's the same thing. It's still coming out of cash flow or whatever. And I mean, let's just withhold on the Roth conversion. No. Think about it. If you are collecting a paycheck or withdrawing from your IRA, something like that, and you increase your withholdings and basically pay more into the IRS from those means, then it's essentially you've got money on deposit with the IRS. You've paid in more than necessary on that income. You then do the Roth conversion, convert those dollars, they land in the Roth IRA, and don't withhold on it. Now you've created some income without any withholdings. You've withheld extra on your other income, and it all balances out. You've got to do a tax projection to do the math and make sure that you're withholding properly. But the end of the day, like at the end of that, like the result of that is you've got as much money as possible landing in your Roth IRA, growing tax-free for your financial future, which is the A1 objective. And then the third thing that you can do instead of withholding on a Roth conversion is to pay in a tax estimate. And certainly if you're retired, you're going to want to align your tax estimate in the same quarter that you do the Roth conversion, because that will ensure that you're not having to pay underpayment penalties. And yes, paying a tax estimate comes out of cash flow, but it's worth it. Again, because if you're doing a Roth conversion, it's possible that you're not able to contribute directly into the Roth because you're already retired, you don't have earned income, so you can't contribute to the Roth. Or again, you want to have as much income as possible growing tax-free as you can, and therefore it's worth it to look at the conversion. Oh, it's going to cost me about $2,000 of taxes. I've got $2,000 in our cash flow or in the bank that I'll just write an estimate. I'll pay an estimate. And therefore, doing that conversion, you don't need to withhold taxes. All of it lands in the Roth and is able to grow for your financial future. You're in good standing with the IRS because you made a tax payment. You made it on time because it was an estimate in the same quarter you did the Roth conversion, and taxes covered. So the point is you have options. You have options. Even though the Roth conversion is a taxable event, it doesn't mean that you have to withhold taxes when you do the conversion. Now, to be fair, again, you can. But I would look at withholding taxes from a Roth conversion as sort of the last choice, not the first. And for many people, they think it's the first because it's the easiest and it's logical. But I would look at it as the last choice. Is there any other way you can cover the taxes on that Roth conversion without withholding so that you get the maximum impact, the maximum amount of that Roth conversion lands in the Roth, growing for your financial future? Might require some creativity. Work with your certified financial planner on that. And certainly you're going to need some help from a financial planner building out that tax projection to do that analysis to see how much should you convert, what will the tax impact, what sort of withholdings or already payments have you already made to the IRS, and therefore where else and how much extra would need to be paid into the IRS to be in good standing. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.